The head of the U.S. Central Bank says the White House is using a criminal investigation to pressure the bank into cutting benchmark interest rates. Federal Reserve Chair Jerome Powell says the Trump administration is threatening to indict him over an office renovation project. The public rift has sent the U.S. dollar lower and gold prices higher as global investors question the bank's long-standing independence. Powell says the threatened prosecution is meant to force him to cut rates, which Trump says would boost the economy, but most economists say would increase inflation.
I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president.
Let's bring in Francesco Bianchi. He's a professor of economics at Johns Hopkins University. Welcome, Francesco. Now, Powell has been on Donald Trump's hit list for quite a while. Why the criminal investigation now?
First of all, thanks a lot for having me. From a technical point of view, the accusation against Powell is that he lied to Congress about a large-scale renovation of the Federal Reserve's headquarters in Washington, D.C. So this is a large project. It's around $2.5 billion. And the claim is that the expenses were not reported in the correct way, and the scope of the renovation was not reported in the correct way. So that's the legal basis, I would say, for this investigation against Jerome Powell.
The independence of the U.S. Central Bank is at stake here, says Powell. Is he right?
Absolutely. So I'm not a lawyer, so I cannot really tell whether the legal basis for the investigation are solid or not. I think lawyers are more qualified to judge this particular aspect. But definitely this is coming. The timing of this investigation is coming, like you suggested a moment ago, after many months of increasing pressure on the Federal Reserve to cut interest rates. So President Trump feels that interest rates are too high compared to where the economy is. He doesn't see really a risk of inflation, and he thinks that rates should be lower. Nevertheless, typically presidents refrain from, at least publicly, criticizing the Fed or suggesting what kind of monetary policy should be implemented. So while there might be some reasons for looking more in detail in what happened with this renovation, the timing is a little bit suspicious because it comes after this increasing pressure on the Federal Reserve, increasing threats to central bank independence.
If the U.S. were to get to a point where the president, in fact, dictates Fed policy, what would the impact be on the United States and, of course, the world economy as well?
Yeah, it is a little bit concerning because the central bank controls short-term interest rates. So the president can certainly pressure the Fed in lowering interest rates. But ultimately, I believe that the goal of the president is to lower long-term interest rates. And the reason why that should be the goal is because mortgage rates, the rates that the household face when buying a home, or car rates the rates that they face when they try to buy a car, are typically long maturity rates. Let's say 3 years, 5 years, 10 years, 30 years. So if markets lose confidence that interest rates in the United States are set in an independent way to control inflation, they would want to be compensated for the risk of high inflation in the future. So in other words, if markets lose confidence that it's the Fed independently calling the shots about monetary policy, instead they become convinced that the president is going to have a say in how monetary policy should be conducted, they're going to ask for larger premium. And so that paradoxically will drive up long-term yields as opposed to lowering long-term yields. That is, I think, ultimately the goal that President Trump has in mind, because related to the affordability crisis that is now at the center of his internal agenda.
These attempts of intervening in the Fed's policy making, has anything like this ever happened in the past?
That's an excellent question. So I would say this is not new. So it's not new for a president to interfere with the policies of the central bank. There are some important examples in the 70s with Richard Nixon, and before him with Lyndon Johnson. So this has happened repeatedly. It came to a stop once, I think, the political branch of the US government realized that this was backfiring. In the sense, the US experienced, like many other countries, high inflation in the 60s and 70s. And in part, the reason why inflation was so high is because of this political interference. Now, what is absolutely new, it's totally unprecedented, is these very vocal attacks on the central bank independence. And I think that is causing damage in itself. So in other words, there is a difference between in a private meeting suggesting to the chairman of the Fed that you should keep rates a bit lower versus publicly attacking the Fed as an institution, because that undermines confidence of financial markets in the future behavior of the Federal Reserve. So political pressure is not new, but the way it's conducted is new.
That was Francesco Bianchi, a professor of economics at Johns Hopkins University in the United States. Thank you so much.
Thank you for having me.